welcome to my channel. I'm Norris and I'm here to share with you about my stock account update. Today my stock account has made a loss of $548. The market is continuing to focusing on the bank's crisis. Dario and BlackRock FinCEN warned Silicon Valley Bank of volatility, the widening rift in the financial system, and a rolling crisis. Right now, the net asset of my account is $76,892.89, including the post-market price. I've made a total loss of 1.08% today. Today, DRV made a gain of 0.66% in the post-market, while SQQQ made a total loss of more than 1.5% to $36.77. As for the market today, market closed mixed, with most of the tech industries closed with a gain, and the banking industries, the financial industries, closed with a loss of more than 2%. Dow Jones Industrial Average, affected by the financial crisis of Silicon Valley Bank, decreased for 0.87%. Nasdaq Composite Index rose for 0.05%. and the S&P 500 index made a loss of 0.7% to $3,891.93. Wall Street closed mixed on Wednesday. Recent pressure on the financial sector has come after Credit Suisse revealed that its internal controls had found significant flaws, and that its major shareholders had refused to inject more capital. Both U.S. February PPI and retail sales data showed easing inflationary pressures, reinforcing expectations that the Fed would no longer raise interest rates aggressively. U.S. regional banks fell on Wednesday's morning. The sector regained its footing in the afternoon trading after Swiss regulators announced that the country's central bank would give Credit Suisse liquidity support if necessary. In recent days, with the collapse of Silicon Valley banks and signature banks, the crisis in the financial sector has focused on regional banks. Both Silicon Valley banks and signature banks have been victims of mismanagement of the Fed's 8 rate increases in the past 12 months. U.S. stock investors turned their attention to the big banks on Wednesday as the crisis at Credit Suisse deepened, fueling surging pressure on the financial sector in recent days. Credit Suisse revealed that its latest earnings report that its internal controls found significant flaws, while National Bank ruled out continuing to invest in Credit Suisse. Asked if he would like to invest further in Credit Suisse, Ammar al-Qudari, chairman of Saudi State Bank, reportedly said, "The answer is absolutely no. There are many reasons beyond the simplest reason of regulation and regulation." Al-Qudari said a more than 10% stake would create additional regulatory hurdles. The Saudi State Bank bought a 9.9% stake in Credit Suisse late last year, becoming Credit Suisse's largest shareholder. Credit Suisse on Wednesday had called the Swiss National Bank to public support it, while Swiss regulators promised the central bank would give Credit Suisse liquidity if necessary. According to the media reports, Credit Suisse released its 2022 annual report after the close of U.S. stocks on Tuesday. It reported a pre-tax loss of Swiss francs 3.258 billion and a net loss attributable to shareholders of Swiss francs 7.293 billion. Worrying investors most, Credit Suisse is trying to remedy it after saying it has found significant flaws in the reporting process for the fiscal years 2022 and 2021. The group said that PwC issued a negative opinion on the effectiveness of the group's internal controls over financial reporting process, ended December 31st, 2022. Issues related to the group's failure to design and maintain effective risk assessment in its financial statements and various deficiencies in internal control and communication. Credit Suisse report did not specify whether the issue had been resolved, but it had discussions with the Securities and Exchanges Commission (SEC) have been completed. Before the major flaw, Credit Suisse already faced liquidity risk, perhaps the most concern. As early as the end of 2022, The company reported that the cash deposit withdrawals, non-renewal of due time deposits, and net asset outflows were significantly higher than in the third quarter of the same year. In addition, in the fourth quarter, Credit Suisse consumer withdrawals exceeded 110 billion Swiss francs, 830.3 billion yuan. The Fed is meeting next week. A number of banks, including Credit Suisse, have exploded, making the Federal Reserve's interest rate hike expectations variable. Fed's watch tool has the highest chance of setting the end rate at 5%, currently 4.5% to 4.75%, while the policy rate is most likely to fall through 3.75% to 4% in December. Bleakley's financial group analyst Peter Bookwer says the pressure on the financial sector has generally increased as several bank failures have changed their industry mentality. What this tells us is that banks will embark on a massive credit extension contraction, and they'll focus more on consolidating their balance sheets than on lending. He added, was a reflection on the market's balance sheet. He also noted that many banks have bought some long-term bonds, whose bonds have consistently fallen in value since the Fed began raising interest rates. Bookwer said, again, you have to worry if many of these banks will be forced to start raising money by issuing shares. On economic data on Wednesday, the Labor Department reported that the U.S. Producer Price Index fell 0.1% in February. The market is expected to grow 0.3%. Another data showed U.S. retail sales fell 0.4% in February month-on-month, compared with a 0.4% decline and a 3.0% gain last month. Dario and BlackRock FinCEN warned Silicon Valley banks of lethality, the widening rift in the financial system, and the rolling crisis. Bridgewater founder Dalio said the Silicon Valley Bank collapse was an early sign of the canary in the coal mine, which would have a ripple effect in venture capital, even far beyond its range, or paying the price for decades of loose money. BlackRock's CEO Fink said, rapid interest rate hikes is the first domino to fall, while Silicon Valley banks and leveraged investors may follow the lead, and funds investing in illiquid assets may be the third. After hedge fund tycoon Bill Ackman, a growing number of Wall Street celebrities have warned of the lethality of the Silicon Valley banking crisis. Dalio, founder of Bridgewater, the world's largest hedge fund, said the collapse of Silicon Valley Bank was a sign of a widening rift in the global financial sector. The global economy is entering a new era in the past year after major central banks raised interest rates to curb inflation. The impact of the shrinking debt and the credit market will start to intensify. In an earlier Wall Street article, Dalio posted on LinkedIn on Tuesday that the collapse of Silicon Valley Bank was an early sign of the canary in the coal mine, which would have a ripple effect in venture capital, far beyond the scope of venture capital. Dalio believes that we are approaching the turning point from the strong tightening phase to the contraction phase of the short-term credit and debt cycle. We're in the early stages of the cycle contraction phase. The leveraged assets are large, and a lot of problems are after the collapse of Silicon Valley Bank before the end of the cycle contraction phase, he said. This turning point in contraction. But as the trade-offs get tough, I'll be watching its actions closely, Mr. Dalio said. Looking ahead, it may not be long for some problems that will eventually lead to protective measures by the Fed and the bank regulators. In an annual report to investors released on Wednesday, BlackRock CEO Fink warned that U.S. financial system faces a slow-rolling crisis following the collapse of the Silicon Valley Bank, and that more institutions will be taken over and closed in the future. In his letter, Fink said the collapse of the SVB as an example of we're paying the price for decades of money easing. A quick rate rise is the first domino to fall, and the SVB is the second. Other regional banks and leveraged investors are likely to follow the lead. Funds that invest in illiquid assets such as private equity for real estate, and real estate could be the third one to fall down, especially those that use borrowed money to increase their returns. Fink expects regional banks to remain at risk after the collapse of SVB. High inflation to come, the Fed to raise interest rates further and interest rates to continue to rise. After the crisis at regional banks, the financial sector could see what he calls a liquidity mismatch. As low interest rates prompt some asset owners to increase their exposure to high-yielding investments that are not easy to sell. The bond market fell to 15% last year, but as those old Western movies say, it still seems too quiet. The fastest pace of rate hikes since the 1980s have exposed cracks in the financial system, and it is bound to have other implications. Fink believes it is unclear whether the banking crisis caused by higher interest rates will become more victims, but that some banks will now inevitably shrink their loans to strengthen their balance sheets. Rapid action by regulators could help to avoid a widening scope of the crisis, but the market remains tight. In a more divided world, he expects supply chains to be disrupted, inflation to persist, and inflation more likely to remain to 3.5% or 4% in the next few years. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.